$100,000 on our house, and we have around $60,000 on a second mortgage when we were doing
a second mortgage.
Dave Ramsey-ish, and my husband built a barn that he uses as like a side business. But so we were wondering if we should...
anything? Does that pay anything? People tend to complicate their lives too much, man. Just take things step by step. Hey guys, I'm Bryson. Welcome to the Tommy Bryson Show, where we react to things. And today we're reacting to Dave Ramsey and a video he made, basically talking about hey, is refinancing my home, does that mean, for example, starting over? Now, Tommy, why react to this stuff? Because basically, it's important stuff, okay? And it makes sense to do it because basically, especially right now, rates are so low, and everyone wants to know, hey, is it making sense to actually go ahead and refinance? And by the way, usually, refinancing makes sense in the early stages of the mortgage because that way you'd have to start all over as far as, for example, the interest is being paid more instead of the capital. But that is a topic we're going to get into this video right here. Now, if you guys are new here, I post videos on Tuesdays, Thursdays, and Saturdays, okay? So make sure to go ahead and basically subscribe and hit the bell so you're notified. And on top of that, if you want to support the channel, go ahead and basically like this video. Without further ado, though, let's find out what Dave Ramsey do, though. That does not make sense, but let's move on, okay? Ooh, yo, the Dave Ramsey intro is so fire, bro. I love it.
Robin is in Cleveland, Ohio.
It's almost like a movie.
Hey, Robin, how are you?
I'm doing...
Yo, Dave Ramsey has changed so much. The guy is just so like a beacon of light. He's just chill. He's just so nice. You barely ever hear Dave Ramsey freaking out like he used to and stuff like that. So that's awesome.
All right. How are you today?
Better than I deserve. What's up?
I have a question. My husband and I are finished.
Yo, Dave Ramsey's losing weight, guys. Look, you can tell Dave Ramsey is losing weight. Congratulations, Dave.
Finishing up baby step 3. We have about 5 months in savings, and we're debating on whether we should refinance our home.
Interesting. Baby step 3, they have 5 months worth of expenses in their emergency account. Let's hear about it. I don't really know the whole baby step. I know like step 1 is $1,000, 2 pay off debt, 3 emergency fund, 4, 5, 6, 7. It's 7 of them, right? I think you do the last 4 in combination almost.
We have $100,000 on our house, and we have around $60,000 on a second mortgage when we were doing
a second mortgage.
Dave Ramsey-ish, and my husband built a barn that he uses as like a side business. But so we were wondering if we should...
anything? Does that pay anything? People tend to complicate their lives too much, man. Just take things step by step. Everyone wants to spend so much money and starting a business when they don't have any money, but they have credit. But when they don't have any ways to actually do it, no credit, no money, they figure out a way to do it, right? Be careful. $100,000 for a barn. Oh my God.
Refinancing can combine the barn and the house on the same payment plan.
Yeah. What's the interest rate on your first mortgage?
Our interest rate on the first mortgage is like a 3.7 and
3.7%. By the way, usually 1 to 2% is okay when it comes to refinancing. Sometimes not.
And on the barn, it's like a 6.2.
Jeez, that is a big difference. 6.2. I wonder if it's like a 10-year, 15-year, 30-year. What is it?
Yeah. And you're going to stay in the home a while?
Oh yeah, we don't plan on ever leaving.
Definitely refinance it. While you're at it, put it on 15-year.
Boy, that is crazy. Look at that, man. And by the way, Dave Ramsey is not telling you to go into any more debt. What he's saying is basically just refinance, put it into one payment, and then that way also you also lower the interest rate. As long, the bad thing is usually when you tell somebody, well, just get one big loan, pay off all your credit card debt, because now you have this one big loan, but you also have a whole bunch of available credit. You know what I mean? And before you know it, now people will go ahead and max that out now. And they also have the new loan. And they're like, what do I do now? You know what I mean? So you want to avoid that.
You can get cheaper on the barn and cheaper on the house.
Yeah.
And so you got $160,000, 60,000 of which you're going to save 3 and some change.
And by the way, the good thing about this entire idea is that basically, after paying for this long, most likely they've improved their credit worthiness. So that also shows a reflection. And especially because the rates are so low right now, they're able to kind of lock in a very, very low rate, which is actually pretty good. And if you go from 3.7, all the way down to 2% or like 2.5% plus the barn is 6%, you can save a ton of money on $100,000, by the way. This guy needs to slow down with all this debt.
And you're probably going to save about 0.75% on the $100,000 on the first.
Yeah. on a 15-year mortgage.
My husband's concerned. He says he feels like he's starting over. I don't know how to help him through that.
Well, you help them through that, right, by doing math, right? I think that's the best way to do it. I think people have this whole perspective of, well, I don't want to start over all the way again, right? Because it's 15 years now. I don't want to start all over again. Well, just do the math, okay? If I keep paying this for the next 20 years or whatever it is at a 6.5% or whatever it is, how much is that in total interest? And if I were to restart, for example, at a lower rate, to put everything in one payment, how much interest would that be in 15 years, right? If I pay it off even sooner, well, the math is going to tell you what's going on here. Your opinion, your feelings don't matter. They're important, but you got to get the facts. And once the facts are there, you got to get over this entire hurdle of, but I feel like I'm starting over again. Well, it doesn't matter.
I feel like it's starting over because we've already been paying on the house for 10 years.
Yeah, there's some people don't. He's one of them.
And by the way, the whole starting over thing, a lot of the times, basically, we've been paying on this house for 10 years. What happens is an amortization schedule of, by the way, it's just a fancy word for saying like payment schedule. But the whole idea is that, you know, on the first 1 to 5 to 10 years, usually of a mortgage, you're paying more towards interest than you're paying, for example, towards capital. So when that shift actually happens to now, for example, you're paying more towards capital than you are towards interest, you don't want to kind of go back to all the way over again where you're paying more interest towards capital. That is fine, though, when you're going to save so much more money in the long term. It's not about what it looks like. It's about what it is.
They have the idea that you pay all the interest up front, and that he has to start over paying all the interest. And that's because when you look at an amortization schedule, when you look at your payment schedule and how much of it is going to interest out of the very first payment, it's almost all interest.
Yeah, it's so crazy, right? It's crazy. But it's a part of the game. When you think about it, right? Can you picture that, guys? When did it become okay to buy something that is gonna be so expensive to the point where it's gonna take 30 years to pay it off? You know, I mean, it's economics, right? It makes sense. But it's so crazy to think about that, huh? Buying something that's gonna take that long. Like, you can buy it at 20 and by 50, you're done paying. That's crazy, man. That's why I'd rather buy cheap and pay it off faster and just call it a day and be done in 8 to 10 years. I don't like it.
And that makes you think you're prepaying interest up front.
You don't. You don't prepay interest. You're just basically paying based on the capital that you actually
Sometimes. You're not. He's not starting over. So the way the interest is calculated on a traditional, conventional mortgage is, it's based on the outstanding balance that month.
Yeah, exactly. Like a credit card also, right? Well, yeah, like a credit card too. So if you owe $1,000 on a credit card, and let's just say, for example, crazy credit card here, don't ever get into this deal, but they're going to charge you 10%, right? Well, that means, for example, you're going to pay $100 in interest for that month, but your payment is, for example, $200. So now, let's say $150. So let's say, for example, you're being charged $100 on the interest because 10 times 100, well, 10% times 100 is $100. But then also you're paying $50 towards the actual capital. That means by next month, now you're paying, for example, 10% on $950. So now your new thing is around like $95, right? Is it? Yeah, $95. So now it looks like you're going down, but you're only going down because basically you're paying some of the capital off. Although it looks like it's very offsetted on this massive amount of money, it's still the same thing.
And so your very first payment, you have the largest outstanding balance you will ever have.
Yeah.
And so you have so a higher percentage, 99% of that first payment goes to interest, right?
Yeah.
You've seen that math schedule, right?
Yeah. Oh, yeah.
Okay. So let's just pretend. Let's pretend it was.
Look at this, guys. Look at Dave Ramsey and his little sponsored stuff, huh? Ramsey Plus, budget with confidence. Click the link below, guys. Wait until I release my app and all that stuff, man. It's gonna be awesome.
3%, which would be 0.25 a month. A quarter of a percent a month would be 3% a year. Okay.
That's awesome.
So whatever's outstanding that month, a quarter of a percent is going to be owed on it. If your interest rate's 3%. And so he's not starting.
What it means is basically, if you guys don't get it, is that if your interest rate is 3%, right, it's not like you're going to be paying 3% per month. It's more like 3% divided by 12, and whatever that is, you're being charged that per month. Does that make sense? So if you have like let's just say for simple math here, interest rate of 12%, right? 12% per year, which is crazy, but divide that by 12 and that's 1. So every single month you're being charged 1%. that on the outstanding balance, obviously. That's
over. He's got $160,000, and 1/4% of that will go to 1/4% will be his portion of the payment, and the rest of it will be principal, which will be a tiny, tiny bit. But you're not starting over. Mortgages are not front loaded with interest.
Yeah, that's not what they are. Imagine though if that would be a trash deal, because if you go, for example, bankrupt, like it's kind of like you don't get anything, right? Imagine like a deal where the mortgage is like front loaded, where basically the house is $100,000, you get charged interest, but the first 10 years are just interest, so just the bank making this money, and then the later, for example, 20 years, are you actually paying the balance? That's crazy, because if things go wrong or incorrectly, for example, you don't have any equity in the property or anything whatsoever, so you don't want that. We don't want that.
Okay.
That's what he misunderstood that.
Yeah, that's what he's getting hung up on. He doesn't want to start over.
He's not starting over.
We're doing well.
He's not starting over.
Okay.
He's starting in exactly the same place he is, but with a lower interest rate.
Yeah.
Because this month he's going to get charged 1/12 of 6% and some change, which is 0.5% on.
That's crazy.
The $60,000. This month he's going to get charged 1/12 of 3.7%.
By the way, David's math is crazy too. By the way, he's pretty good at math.
On the $100,000, and the rest of it is going to go to principal.
You guys ever wonder, like, what is this car about over here since 1965? What's that about?
It's simple interest calculation. The outstanding balance times the interest rate is the amount of interest charged that month. There is not a front load on a mortgage.
Sometimes things are that simple to break down.
It's only charged for what you have outstanding, so you're not starting over. Do a 15-year.
All right, guys, so that is about it for this video. David recommendations basically just refinance, of course, doesn't make sense, and get rid of that idea that you're starting over, because in reality, you're not starting over. You know, maybe I'll make a video about this stuff, because it makes a lot of sense in the main channel. But guys, overall, I had a lot of fun watching this video right here. Simple video, but it makes sense, and it's also very helpful. And sometimes you get hung up on the little basic things. I don't want to start over. But an emergency account, but I want to invest. I don't want to have to stop investing. I don't want to pay any debt. You know what I mean? So it's all about making sure that things actually make sense. I'll see you guys tomorrow. Thanks for watching this video. If you guys want to call me and talk to me directly, join me on my third channel called Ask Me Bryson, where I take calls from Monday to Friday. Link is down below. Schedule a call today. On top of that, also subscribe to this channel and also like this video. It's your way to show support. I appreciate it a ton. By the way, guys, it helps the channel grow a ton. I appreciate it. On top of that, also, if you guys want to DM me on Instagram, DM me right here at Tommy Bryson. And before I go, here is another video right here. Click it and watch it. On top of my face right here, subscribe to the channel right now. I'll see you guys tomorrow. And as always, peace.